Today's market move looks calm on the surface, but underneath it tells a much more interesting story. U.S. Treasury yields are pulling back, equities are trying to stabilize, and investors are once again recalibrating expectations around rates, growth, and risk. In this video, we'll break down what today's move in the 10-year yield really means, how the S&P 500 is reacting to it, and why Nasdaq remains more fragile despite the broader market holding up. Let's start with the 10-year Treasury yield. Today, we're seeing a noticeable pullback, with yields moving lower during the session. This decline suggests that bond markets are becoming slightly more cautious. Lower yields usually signal one of two things, either expectations of slower economic growth or increased confidence that the Federal Reserve will not need to stay aggressively restrictive for much longer. What's important here is the context. This is not a panic move into bonds. The yield is still elevated historically, but the market is clearly stepping away from the recent highs. From a macro perspective, this kind of move often acts as a pressure release valve for equities. When yields stop rising, valuation pressure on stocks, especially growth stocks, starts to ease. In simple terms, today's TNX move tells us the bond market is cooling, not breaking.
Now let's look at the S&P 500. SPY is trading mostly flat to slightly positive, showing resilience rather than strength. This behavior fits perfectly with what we're seeing in yields. When rates pull back modestly, the S&P often enters a consolidation phase instead of pushing aggressively higher. What stands out today is the lack of strong follow-through. Buyers are present, but they are selective. There's no broad-based risk-on behavior, just steady accumulation in large-cap names. This tells us the market is still in wait-and-see mode. Investors are comfortable holding exposure, but not confident enough to chase prices higher. In other words, SPY today reflects balance, not optimism, not fear. The Nasdaq paints a slightly different picture. QQQ remains more volatile and noticeably weaker compared to the S&P 500. This makes sense. Technology and growth stocks are far more sensitive to interest rate expectations, and even a small uncertainty around future yields can limit upside. Despite yields moving lower today, Nasdaq is struggling to regain momentum. That suggests investors are still cautious about valuations and earnings durability in the tech sector. What we're seeing here is not distribution, but hesitation. The market isn't aggressively selling tech, it's simply demanding better confirmation before committing more capital. As long as yields remain range-bound rather than falling decisively, QQQ is likely to underperform SPY in the short term.
To sum it all up, the bond market is cooling, not signaling stress. The S&P 500 is stable, supported by large-cap strength, and the Nasdaq remains the most sensitive piece of the puzzle, reacting cautiously to every shift in rate expectations. This is a classic environment of consolidation, not a top, not a breakout, but a market digesting information. For now, the key variable to watch remains Treasury yields. As long as they continue to drift lower or stay contained, equities can hold their ground. But for a sustained rally, the market will need clearer confirmation on rates and growth.